Good afternoon, everyone. And first of all, thank you for this opportunity. It is a great honor to address the august audience here in terms of the key topic today. What I thought of is on conviction, how to play conviction in our portfolios. Today we are in a world where it's a VUCA world, volatile, uncertain, ambiguous, and also you don't know tomorrow what exactly the tweet will be and how the markets are going to turn. That's a nature of the markets in which we are in today. But what we always have to remember is, say for example, Warren Buffett quote is there, which says like this. Typically, when we look at from a perspective of investing, people say that today we are always surrounded with a lot of noise on passive investing. Go and invest in index funds. Go and invest in different types of instruments which are giving index kind of returns. Systematically invest in an index fund and so on and so forth. But all of us are gathered here mainly to create alpha. Now, to create alpha, to create extra returns over the index, index investing will not help. Warren Buffett says in a very famous quote, saying that put all your eggs in one basket and watch the basket. That's the principle which I believe very, very strongly. Mainly because of the reason that if you know how to do research and if you know how to dwell deep into each and every part of your portfolio, then it becomes very interesting for you to watch the basket. Say, for example, if I tell you to invest in only 10 ideas today, your clarity of thought will be much higher. You will hunt for ideas which will be more prudent for your portfolio. 10 ideas if only you can choose from, and if that constraint is there in front of you, you will think hard and you will make a very interesting choice. And that is the beauty of conviction investing or strong high conviction bets in your portfolio. So what do we need to do? How do you create conviction? Many times when you say about index investing or any kind of mutual fund, also if you see 50 odd companies or 100 companies in the portfolio, many times it is because of the size or various reasons, or index hugging is the model because you have an index to outperform. But if you naturally think that you want to create only a portfolio with the 10 ideas, and if you want to make a difference to your portfolio, how do you do that? So, 34 years of investing experience of mine in the last 25 years of professional fund management, what it has taught me is that you have to be convinced on your ideas in certain fashion. I'll give you 4 simple ways to think about it. If you think about creating a portfolio, the first idea what you need to have is how do you allocate money to an asset class. There are 4 key problems any individual will have when you are creating a investing bouquet or creating a portfolio. First and foremost is you need to have a clear plan how will you allocate money to different asset classes. That is the first problem that you need to have in mind, right? So if you don't have an answer to it, first find an answer to it. It could be a data-driven decision-making approach which will help you to take that decision. Because many times people say that we want to look at a high-quality stock, bottom-up research. All are important, fundamental research is important, but at the same time, First and foremost, in my view, and over a period of time, it has repeatedly made me think and react, saying that you have to think about the asset allocation as the first choice. Which asset class you are betting on? If it is in equity, if it is fixed income, or gold, or real estate, whichever asset class may be, that has to be thought through well. That is the first problem you need to solve for which you can have a good data-driven decision-making approach. The data can tell you that where the valuations are excess or the valuations are cheaper. Secondly, you need to think about how you will find within if you decide that you are going into one asset class, say for example equity. Now equity also have different dimensions. First and foremost is large cap, mid cap and small cap. Typically people might say that small caps are good companies to invest from long-term perspective, but the valuation or the entry point also has to be very, very sharp. So you need to have a very clear thinking on what is the typical allocation mechanism that you're going to have between large companies, mid-sized companies and small companies. That also decide the fate of your portfolio, right? So for which again you need to have a process or a method to the madness. If you don't have that solution right, many times your results will be very mediocre. So to create a conviction on a particular stock or a portfolio, you need to go through these different boxes. First one I spoke about is asset allocation. Second is within the asset class, how to allocate between different segments. Be it in fixed income when you say that long duration, mid duration and short duration. In the case of equity, large cap, mid cap, small cap. Or in the case of equity, you can take other cut saying that whether you want to be invested in which sectors. So within equity, I feel this third biggest, the first we said that you need to be invested in a different market cap, and then you look at within a market cap, how will you allocate to different sectors or stocks. So you need to have a clear plan to have a sectoral allocation also. So asset allocation, market cap allocation and sector allocation, and then coming to the fundamental research and the bottom-up research for stocks or bottom-up research for bonds, that decide your conviction. If all these four quadrants, if you are having a plan in place or a method to build conviction to arrive at a result from these quadrants, then you will be in a better position to arrive at a very high conviction portfolio. This is how at ASK we build conviction on our portfolios. If you want to create a 20 stock portfolio or 15 stock portfolios, this is what we try to do. Now, all these things come with a risk. How do you minimize the risk? So this is where it becomes an art. You look at a lot of statistical measures can be used to understand or optimize the risk quotient of each portfolio, the risk appetite of yours versus the portfolio how you are constructing. But at the same time, you need to go through these four key quadrants. In the year 2008, how many of you remember that the large cap index fell by 67% and small cap index fell by 83%. So if you are not realizing what valuation you are betting on, and secondly in which segment of the market you are betting on, or which part of the economic cycle or market cycle you are betting on, or which sectors you are exposed to, or which asset class is more vulnerable. You can have these kind of massacres in the portfolio also. You might say that SIPs are good, SIP sahi hai, but mutual funds sahi hai, but all the points, if you're building SIPs over a period of next 5 years, what happens is that becomes a lump sum, and eventually that can potentially be vulnerable to the sell-offs and market crashes. So allocating money at the right point in time to the right asset class, right market caps, right set of stocks, finally doing all the bottom-up research will make you build a very high conviction portfolio. Now, last point I want to highlight is, if you look at Nifty itself, now Nifty 500 index, if you see this index, any subset of that has formed as Nifty 50, a 50 quality index or 30 value index or 30 quality index, the return differential between the broad index is significantly higher on whichever time frame you look at it. What it suggests is that just by a methodical or systematic way of screening down stocks, which is done by NSE, that itself is giving you a differentiated return over the benchmark, and it is outperforming the benchmark. Systematically, if you do the same way of 20 stocks portfolio, well thought out, planned asset allocation mix, market cap mix, and also the stock selection mix, you have it in the portfolio, it potentially can give you wonders in your entire wealth creation journey. So my learning of so many years is that you need to have a very clear plan for the client. If you're sitting with a client, to see that whether these methods are utilized to build a very high conviction portfolio. If you don't use these methods, what happens is that you end up having a portfolio which is very diverse, and people say that diversification is good, but that is not going to yield extra alpha. If you see globally, all of them are running behind alpha. It is a high yield chasing market. It's a volatile market, but unless otherwise you have a situation that you're building a portfolio with a high conviction stocks, high conviction bonds, and which can stay the course over next 5 years, 10 years, you are not going to create extraordinary wealth. So this is simple formula in my mind, which has helped me to create alpha or create wealth for myself, and also what we do at ASK in form of creating a very high conviction portfolio which will enable a long-standing wealth creation experience. Thank you.